FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
China looks like fully engaged in the currency wars. Where's it all going to end? Well, I think somebody once wrote a book about it and even wrote another one. Got John Rubino, Dollar Collapse, and the Money Bubble. John, welcome back.
Hey, Kerry. Good to talk to you again.
Hey, so what's going on here? It looks like things are not so coming up roses in the land of, well, in Beijing, are they?
Yeah. Well, one of the really remarkable things about the past year is how quickly China has gone from being the world's savior to its major risk factor. And a little background on the story is that when the developed world stepped off a cliff in 2008, China responded by borrowing huge amounts of money and spending it on infrastructure development. They built roads and bridges and skyscrapers and power plants and whole cities, and all with borrowed money. And so the resulting demand for iron ore and wind turbines and just about every other industrial commodity or device helped offset the plunge in demand from the U.S. and Europe, and that turned what could have been a global depression into just a severe recession. But now the chickens are coming home to roost. It turns out that so much of what China borrowed and built was malinvestment. It was stuff that isn't going to pay itself off, and the companies that did the borrowing and building are now starting to go bankrupt. And you've got a wave of defaults coming on Chinese debt. And in fact, Zero Hedge today had an article about how the housing bubble in China is bursting, and people are demanding their money back because they didn't understand what they were getting into. And so the question now is what happens going forward? Because China has never really seen a housing bubble burst, an industrial building bubble burst. They haven't had this happen because they've been basically a command and controlled economic system for such a long time that people within the country, I don't think, understand the concept of a major correction. And so it's really a political issue. They're demanding the government do something about it. And it looks like the government is responding with, surprise, surprise, easier money and a depreciating currency and probably more infrastructure spending. In other words, they're going to react to their domestic crisis in the same way that the U.S. and Europe and Japan have reacted to theirs, with aggressive monetary ease and an attempt to depreciate their currency. In other words, they've joined the currency war. And for China to do this is very big because they, at least in the past decade, have been the world's export powerhouse. And the rest of the world has been pressuring them to make the yuan more valuable over time. In other words, to raise the value of their currency to bring these trade balances back into equilibrium. And if they're going to start pushing down the value of their currency now, that means it's going to put a lot of pressure on the export sectors of the U.S., Europe, and Japan. And we're in such precarious shape to begin with that we probably can't handle an export-driven recession right now. So that's going to force the rest of the major trading powers of the world to push their currencies down in response. So in other words, the currency war has just entered a new phase, and this one could be a big dramatic phase. But in the short run, it looks like a deflationary event for China to have this kind of a problem. And a lot of the markets are responding that way. You know, gold and silver are down today. U.S. stocks are down on the assumption that the world might be heading back into a slowdown or even a recession due to China. But the real long-term effect of this is inflationary, because they're going to respond with easy money and everybody else is going to respond to that. And so we'll be right back where we started with depreciating currencies, rising commodity prices, and incipient asset bubbles everywhere you look. So this is more of the same, but it's a bigger, more interesting version going forward.
Yeah, and there's another aspect to this where evidently these wealthy Chinese need money, so they're now dumping luxury homes. First, it's happening in Hong Kong, where supposedly the wealthy Chinese were driving like huge increases in the Hong Kong real estate market. Now, overnight, the Hong Kong luxury real estate market's gone down 25%, just so quickly you couldn't even believe it. You could see them go down 80%, right? Not unusual for a market crashing to see something like that.
Yeah, when asset bubble bursts, it's really dramatic and really fast. And the prices fall more than anybody who had just gotten into the market lately expect. And sure, you could see continued double-digit annual decreases in the price of high-end real estate in Hong Kong. And, that'll filter into the rest of the world, too, because the Chinese have been big buyers everywhere, at least everywhere that they consider to be interesting. Vancouver, British Columbia is in the middle of a massive real estate bubble right now. And same thing for London and New York City and several other places that are attractive to Chinese buyers. So a big pullback on the part of rich Chinese could have effects, immediate effects on the real estate markets all around the world.
Yeah, I mean, there's an article in Zero Hedge about wealthy Chinese in this one development right near the border in China in Hong Kong, and half the units are up for sale. They were selling for 30 to 66 million HK dollars, which is 5 to 10 million US. And now a third of the units were sold on the first day, if you could believe it, with half of them going to mainland Chinese buyers. And now all of a sudden, boom, they're all on the market at once. And not the sign of a healthy real estate market, is it?
but very familiar. Sounds like Miami condos in 2006 to 2008, right?
Yeah.
And we know how that goes. That was a what was it, 60 or 70% decrease from peak to trough in prices. And so, you could see that again pretty easily. These are just bubbles. It's nothing really remarkable based on our recent history. We've seen this play before, and we know how it ends. What is interesting is that it's happening in this big, huge, new emerging economy where it hasn't happened in the past because China hasn't been able to borrow that much money in the past, and it hasn't had any effect on the rest of the world because China's never been this important. So suddenly we have this new factor out there that we haven't had to deal with in the past, and it's going to be very interesting to see how it plays out in the next couple of years, because a lot of it is going to be based on the reaction of Chinese leaders to this, because they have a bursting asset bubble kind of baked in the cake. There are going to be defaults. There are going to be plunging asset prices and all the turmoil that goes along with that. But how will they react to it? They've basically been in charge of the economy for the last 20 years, where they choose a GDP number, and then they just allocate enough capital to infrastructure spending to hit that GDP number. It wasn't really capitalism in the sense that markets were directing resources to the most efficient uses. It was command and control capitalism, where the government was saying, all right, we need a new city over here, and let's put a power plant there, and oh, this guy, I owe him a political favor. Okay, so let's build a road, a superhighway through his town, stuff like that. And it wasn't being done with an eye towards a return on investment.
Yeah.
And when that kind of thing happens, you naturally get a lot of stuff built that has no business existing in the first place, and is going to cost money instead of make money going forward. And then you have these cash flow problems. So that's what we're going to see in China, and how they respond to it is really the interesting part of the story. And it looks like they're going to respond just the way the governments always respond, with easy money and attempt to depreciate their currency. So the ball will be back in our court in the very near future, and we'll have to respond to a shrinking export sector, and we'll respond the same way too. This is really a game that is going to go on until we lose faith in these currencies that these governments are using to pursue their own ends without regard to what it does to savers or investors. And, the end will be catastrophic, especially for fiat currencies and for the people who depend on them. But getting from here to there is going to be a really wild roller coaster ride.
So what about tapering by Yellen. She's making this big deal. Now we're down to $55 billion a month. How are they going to just reverse this?
Even leaving China out of the equation, tapering, it probably doesn't make any sense because part of the tapering process is it has an implicit assumption that interest rates are going to go back up to historically normal levels because we by keeping them super low, we direct huge amounts of money into asset markets, which cause price bubbles, which are destabilizing. We can't have that go on for too long without a big bubble bursting and causing immense trouble across the global economy. So we have to let interest rates at some point go back up to normal levels. But because the whole world is now over indebted and has gorged on variable rate debt, when interest rates go up, that blows up the budgets of the world's governments. And so for U.S. interest rates, for instance, to go back up to historically normal levels of maybe 6 or 7% on 10-year treasuries would mean a U.S. government interest expense on an annual basis of about $1 trillion. So it would be $1 trillion we're spending without getting anything in return for it. And that would embed a huge deficit in the U.S. budget because if we balance the budget but have $1 trillion interest expense, that means we have to take huge amounts of money away from Medicare and Social Security and infrastructure spending and the military and all these things that have huge, very powerful political constituencies, which makes gutting them impossible. So we create another big problem down the road by trying to taper now. And which means we're in a box that we can't get out of, really. We only have tapering with the problems that I just described, or not tapering with increasing asset bubbles and a huge bursting of some big asset bubble out there. And that's it. There's no third way that's painless. So when Yellen talks about tapering, she's being unrealistic. And whether that's because she's clueless or because she's got some other agenda, where she's trying to affect the markets by manipulating perception and hoping that will fix things, which is probably the right answer, and that will fail. And so we'll be in some kind of a crisis in the not too distant future. And the only question is what kind, and that's based on the policy choices of the governments of the world going forward.
Yeah, exactly. And it's an article I want to talk to you about up next that appeared in The Guardian from the Bank of England on the Financial Survival Network with John Rubino of dollarcollapse.com.
FSN Radio.
Urgent alert. Ex-Secret Service agent claims it's worse than people know. One of Obama's former Secret Service agents recently smelled a rat. What he discovered inside our government was so devastating, he only saw one option. He quit. What's worse, he fears what he found could affect your job, your neighborhood, and most importantly, your family, very soon. It's worse than people know, he said in a recent interview, and I'm not trying to scare you either. We too share his concerns. This is why we've devoted the better part of 3 years collecting solutions for nearly all problems created by intrusive governments, and we've succeeded. Go to hiddensecrets1.info to check out all the details. Our panel of insiders have devised a legal but sneaky set of solutions to help you reclaim your privacy from the NSA, opt out of Obamacare, and make a bundle from little-known investments and small business opportunities. Simply visit hiddensecrets1.info. That's Hidden Secrets, the number 1.info.
The Financial Survival Network. It's all about what's next.
We are back. So, John, I know you caught that article in The Guardian, which dealt with that monetary dissertation from the Bank of England dealing with credit creation and the amount of money in circulation. What are your thoughts on it?
Well, basically, what the Bank of England seemed to be saying here is that money's created in a way that's different from what we've been taught in economics class. The traditional way that money supposedly is created is the central bank creates some reserves, gives it to a bank, and then the bank can lend that some multiple of that out in a fractional reserve banking system. But the paper seems to be saying that it's actually the other way around, that a bank makes a loan, and then that money is deposited in a different bank, which creates reserves for that bank, and then that bank can lend out some huge amount or some big multiple of the new deposit. And what that means is that the money supply isn't really constrained by reserves. If banks can make as many new loans as they want to, which then create reserves, which then can be increased via loans, the system can basically run on autopilot to infinity. The amount of money that can be created isn't constrained by the central bank or anything else. And that is a huge change in the way we look at monetary policy. And to most people, it's not going to be very interesting because it's really, inside baseball, chicken and egg kind of thing. But to sound money people and Austrian economists, it's interesting because this is more in line with what you and I think and what gold bugs in general think, that the fractional reserve banking system isn't constrained by anything and can basically create money in infinite quantities and has been. So it'll be interesting to see how the argument plays out and if it has any effect on economic policy. I kind of doubt that it will because it conflicts with the process that is now in place with central banks thinking that they control the world. And so it might be something that comes and goes without much of a ripple, but still it's been an interesting thing to see out there from a major source.
Well, we've known about it for forever because that was one of the primary ways that they inflate the money supply is through credit creation. And when the banks had a 10% reserve requirement, the amount of harm they could do through it was obviously a lot less. Now it's arguable whether they have any reserve requirement because with the amount of money the Fed's pumped into them, who knows what their real reserve requirement is. But you think of the amounts of money that you're dealing with here through credit creation, it's mind-boggling.
And you can also make the case that we have a shadow banking system just like China does, where we've got all these entities that are able to create quote unquote money that doesn't show up in the money supply, but still functions like money, like the derivatives market. If derivatives are actually debt, which in turn makes them, money in effect, then that means that we've got a quadrillion extra dollars out there that don't show up in M3 and unfunded liabilities of the big pension plans of the world. Those are debts, and therefore they might be considered money and credit. So if we end up reevaluating how money is created and trying to fit a lot of these other money-like things into the monetary framework, then we're going to find out that we have a lot more money out there than we thought we did, and that the currencies that look kind of sound today are actually unsound because the supply of them is almost infinitely greater than we thought it was.
Yeah, if they ever hit the money supply, boy, watch out. I mean, it's just going to be even more insane than it appears to be now, and now it seems to be barely manageable.
Mm-hmm. Or if they implode, the effects of that will be immeasurably greater than we would expect just looking at the amount of money that's in M1 or M2 or M3. The deflationary potential for this is also much greater. So you got just much greater extremes if we consider the money supply to be as broad as it would be if we were looking at derivatives and other things like that.
Yeah, and you go back to Warren Buffett's oft quote, his quote, that derivatives are weapons of mass financial destruction. And just think about it. Once they all start to go, and we almost had it with Lehman Brothers, boy, man, they all start to go. And that's the end of the financial system as we know it.
Mm-hmm. Oh, yeah. Yeah, if derivatives blow up. And something like 3/4 of the almost quadrillion dollars of derivatives that are out there right now are interest rate derivatives. So let interest rates go up a little bit, and that means half of those contracts are underwater. And, we're going to get mass defaults on the part of hedge funds and big banks that are on the hook for all of this stuff. So that's out there. That's in prospect. And it could be very, very possible as a consequence of rising interest rates sometime in the next couple of years.
Yeah, so you think it's stressful to be a banker now, and man, they're going to have to really bar the doors by the rooftops of those big banks.
And they're already dropping like flies. So
Yeah.
and these are quote unquote normal times. Wait till something blows up. Yeah.
Yeah, going to be bad. So we find John at dollarcollapse.com, must reading. That's where I often start my days. And of course, there's a link in the show notes to this interview on financialsurvivalnetwork.com. Go there, sign up for the free newsletter. I got something like really amazing coming out today, if I'm not mistaken. So, John, talk to you again soon. Be well.
Thanks, Kerry. Talk to you next week.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.